Hey guys, welcome to the third installment of this series, or the Market Mastery series. And today we will be working or having a look at market structure. Now, there's a huge debate or discourse online on whether to use indicators or price action or any other concept, which one works best. But from experience and from what I've been viewing, it's very prudent or it's very important that you just rely on one specific strategy, understand it well, and that is good enough for you to get started at being consistent in trading. So in this session, we will be removing all the indicators from the chart, and we will try to look at the charts from a more advanced level, and that is through the eyes of market structure and price action. So what is market structure? So when looking at the charts, you're simply trying to gauge how prices are moving, and this is as a result of the interactions between buyers and sellers. So the market is made up of people coming together at multiple times or multiple points in times, placing either buy orders and sell orders. This constant interaction between buyers and sellers is what drives market prices. So if the majority of the orders in the market are buy orders, then this pushes prices up. And if the majority of the orders are sell orders, this pushes prices down. So this is basically what the outcome of what the price chart is like. So our goal is to understand what the majority is, and therefore dictate or help us identify who to follow or where to follow prices from next. So this is very different from what we talked about in a previous video, where we are looking at chart patterns based on indicators. And if you haven't watched that video, click on the link on the description and this will guide you to that video. So the chart, as you understand it, is simply a footprint of what prices have been doing, and that is a reflection of what the market participants have been doing. That simply is buyers and sellers in the market. So you can use the chart to see where buyers and sellers have been and potentially now try and deduce the next move in the market. So that's simply what market structure is, which represents, or where we're talking about what is the flow of the market. Are we going higher? Are we going lower? And are we likely going to continue going lower or higher in the market? So as you've said, price movement reflects this interaction between buyers and sellers, and it's sort of the footprint, and that's what we're trying to look at when we're doing analysis. So because buyers and sellers have predictable patterns over time, then it's possible to spot these patterns on the footprints, which is the charts, and from that we are able to spot market structure, and that is what we're going to use with the analysis. So market trends in general can be characterized by three main movements. We're either in an uptrend, a sideways trend, or a consolidation, and a downtrend. And this is obviously as a result of buyers, where if you're in an uptrend, then the majority of participants in the market are buyers or bullish. And if you're in a downtrend, the majority of participants in the market are sellers. Yeah. In a sideways trend, usually it's for different reasons. More specifically, when buyers and sellers are matching each other, or when prices show, or the market shows some level of uncertainty. So that's one thing to watch out for when you're doing analysis. So before we go further, we need to know how to add objects on the chart, and we will be getting back on our MT5 charts, both on the mobile device and the computer, so that sort of have an idea of how to operate these items, and then from there we go back to our market structure analysis. So I'll quickly get or log into my mobile device. Okay, so right now I'm viewing both my mobile device MT5 application, and if you've not managed to, or if you've missed out on the session or the guide on how to install MetaTrader 5, visit the first video in this series. You'll have a guide there on how to go about this. So in this section, we're not going to be using indicators. We're going to be marking the chart. That means we need to know how to use objects on the chart, and that's what we're going to do. So on your PC, just go to Insert, and then instead of indicators, you go to Objects. On your mobile version, beside the F button, there's the Objects icon, and that's where you click it, and that gives you access to the object. So you have your horizontal line, your vertical line, your diagonal line, and other tools like an arrow. And if you click on the Add Objects, there's a detailed expand on various lines. So in general, there are lines that you can use. There are channels, Fibonacci, shapes, and other graphical images. So the ones that we'll be interested in knowing how to use, number one are the the horizontal lines. So in this case, I'll just click on horizontal line like that. And then from the PC version, you just bring your cursor to where you want that horizontal line to be. From the phone version, after zooming out or zooming in by pinching your fingers, you just drag that wherever the screen is. That makes it easier. Yeah. So that gives us an easy way to add objects. How to remove them? So for both the PC and the phone versions, there are markings at the end of the horizontal line. It looks like a dot. If it's still on or if it's still visible, that means you're able to still move around this object. So make sure after you've placed it on the right end, just long press on it again, or tap on it once, or double tap if you're using the PC, so that those dots remove or are removed from the screen, and that makes it now a permanent mark on the charts. For you to edit it, simply double click if you're using your PC, or long press or tap once on your phone, and those dotted markings appear, and from there now you can proceed to change the properties of these objects. So basically that's how you will be adding objects onto the chart. And to delete the object, just right click on your PC or long press from your phone, and just it's very straightforward. Okay. The other object we'll be interested in is the Fibonacci tool. And again, still need to go back to our object icon. That is the icon that looks like a square, a rectangle, and a circle on your phone. And on your PC, it's straightforward. Just go to objects and then go to Fibonacci. So Fibonacci tool is important, and we will be editing it a bit, but we'll be using it later on in the video. So just go to Fibonacci retracement, click on it once. Now, for the Fibonacci retracement, you're simply looking at a retracement of a previous price move. Now that previous price move, you need to mark it all the way from the bottom to the top. So something like that on your PC, and if you're using your phone, just start dragging on the screen, and it's going to mark itself like that. Yeah, so those are the two main items you're going to be using for this session. Make sure you know how to add them correctly, and if you've not managed to do so, just repeat the start of this video, and it's going to guide you on that. Okay, now we are done with it. So we're done with adding objects. Let's talk about how the market moves. And you can define market movements in two phases. There is an impulse move and a correction move. So most of your price movement will be categorized into the two. So an impulse move is simply a move in the direction of the prevailing trend. So if it's in an uptrend, then that impulse move will be this push over here, this green line over here. That's your impulse move. Yeah, and then the correction move is a move in the opposite direction. So if you're in an uptrend and the price is moving lower, that's a correction move. Yeah, so you have an impulse, correction, impulse, correction, impulse, correction. Basically, that's how the market moves. So in an uptrend, buying pressure eases from time to time as high prices may encourage profit taking. So sometimes you see that prices have been rising over time, and buyers become reluctant to continue buying at very expensive prices. That's when profit taking happens, and that's when we start seeing a pullback or a correction in prices, because guys start selling, and we have a few guys waiting for prices to be cheaper before continuing to buy. So that's basically why we have a lot of interest building up, and then prices tend to go lower, and then a continuation afterwards. This creates a correction move where prices move in the opposite direction until buyers find interest again. And then this process is the same in a downtrend. Yeah, so in a downtrend, this is just inverse. And now we have an impulse on the lower end, an impulse moving lower, correction, and then an impulse again lower. Yeah, so the impulses are usually stronger than the correction moves because that's where the majority of the interest is. Yeah, so basically that's how you define market movement, especially with some of these assets that tend to fluctuate and change direction over time. Okay, so let's quickly now get to the basics of market structure. We'll be mainly talking about an uptrend, a a downtrend, and a sideways trend. And we'll start with the definition of an uptrend. So what is an uptrend? Yeah. So an uptrend is basically a series of impulse and correction moves upwards. Yeah. So in this case, it's price movement that is breaking new highs and maintaining the lows. Yeah. So if you look at this, for example, we have a push higher, a correction, a push higher. So this push higher broke this high point over here, and we formed a higher high. Yeah. And during the correction move, we didn't get to this low over here. So we are maintaining the lows, and hence we formed this higher low over here. So I hope that makes sense. We have this higher high, maintained a low with this correction move, and then another impulse. So this is basically what an uptrend is. I remember in the last video we used indicators to define an uptrend, but this is a more accurate definition or description or deduction on how to find an uptrend in the market. So it's very important that we know at least the very basic structure. But if you look at a chart, it's never this smooth. When you're checking out charts, it's usually a bit more complicated, and an uptrend will look like this. So we have an impulse, a series of smaller moves within the correction, and even a series of smaller impulse and correction moves in the way up. Yeah. So in real life, it's more, you need a bit more care when trying to define an uptrend and a downtrend, and it's not simply straight lines as we have put it here. So we need a bit more work when it comes to that, but we'll get into that. So now we need to redefine what a low is and what a high is when it comes to the market. So that's what this image here tries to do. So the higher low, remember we've talked about a higher low. This is simply a low that is higher than the previous low. So we made a higher high, higher low. Yeah. But we can refine that definition of a higher low as the base of the move that caused a break of structure. Now, the concept of structure is where we're introducing it right now. Now, what is a break of structure? Anytime prices move past a previous turning point, a swing point or a high point, we say the market has broken structure. So the base of that move is where the low or the higher low is marked at. So coming on to this example, we see that yes, we have our impulse move over here that formed a high, and then we had a series of shorter impulse and correction moves. So this in a lower time frame will appear as a downtrend. But at the very end, we had this push upwards. So the base of this move is where our higher low should be. So this is the assumption that buyers came into the market at this very point, and this is a key level that we need to note, and that's why this becomes our significant higher low, yeah, or a strong turning point for that in that matter. Yeah. So same thing over here, the base of the move that broke market structure is where your higher low should be marked at. So this is very important and very crucial, especially when you get to a real life chart, and that's actually what you're going to look at right now. So let's simply mark an uptrend on a chart. Okay. So we've already done, or we've already covered how to mark objects on the chart, or how to add objects on the chart, and we will be looking at, just a minute, be looking at this chart here for pound. So you can see, first off, we can mark off the highs. So this is a high. So you can use either the wicks or the bodies to mark off your highs or lows. This is another high, which is higher than this high. And this over here is another high. So you can just mark this over here, like that. And then this is a new high. So I'm using the wicks right now. And then from here, we had a high over here. So just to make this clearer, I'll use a shorter line. So I'll start with this over here, and then we have this point over here, which is also another high, like that. And then this one over here, and then this one over here. And then finally, we had this point over here. So you can see we've marked anytime prices formed a new high, we've marked that, yeah? So the move that caused this price to break the previous high is where your low should be. The move that caused this high, the base of the move. So that means your low should be at this point over here. So this is your low. So that's your lower high like that. And then over here, this high was broken by this move. So the base of that move, this is your other low. And then over here, because this first point didn't break this move. So this move over here didn't break this high over here. So we'll be looking at the second one. And you can see that here we had sort of a slight pullback, but this move clearly broke this point over here, yeah? So that's how you mark your lows. And when trading, you're trying to see that price, you're trading away from these lows, yeah? So you try and trade away from these lows because these are significant areas where buying pressure started, yeah? So remember, you're trying to mark the market and you're trying to use chart patterns without indicators on them and identifying that interaction between buyers and sellers. So if I can see that the best of this move is over here, this is where a lot of buying started, then this should be a key area that I should be trading away from. Yeah, so this is one of those moves where you trade away from. And then this point over here. So you can see here we failed to break higher. So my higher low in this case would be this one instead of this one, because this is where we broke high and we broke previous structure and went higher. So in this case, I will mark this. So the trouble a lot of traders have is in identifying, the trouble a lot of traders go through is in identifying exactly what to use as higher high and what to use as lower highs and things like that. So think of the price as waves instead of as individual movements. So if I can view this chart in waves, then I can ignore minor moves and just focus on the major pushes, the impulse, correction, impulse, and correction, like that. So this makes it easier for me to identify any lows or any highs on the chart. So that's very important when you're trying to define an uptrend. And it also gives you a good foundation on when to watch out for changes in character. And that's one thing we'll talk about next. So quickly, let's try and define a downtrend now that we know how to define an uptrend. So a downtrend, on the other hand, is a series of lower lows and lower highs. And in this case, we define price movement as breaking lows and maintaining the highs. So case over here, we made a high and then we went lower than this point, and that is where we broke this low, and then correction move, and then broke the low again at this point. So in this case, we can define this as a downtrend. Now, why do we need to know uptrends and downtrends? Again, we need to know the footprints of the majority of buyers and sellers in the market. So if we can carefully define an uptrend, that guides us on what to do next. It tells us who the majority is and how to go about trading. Now, it's very, you can do this with indicators. So for example, I can come here and say, for example, over here, I can plug in maybe a moving average, like that. So just a minute. So I can plug in a moving average like that. But a moving average, so a moving average in most cases, if prices are below the moving average, we're in a downtrend, and if prices are above the moving average, we are in an uptrend, yeah? But in this entire period, a moving average can get very confusing because prices keep on going above and below the moving average. So it can get a bit confusing when you're using indicators, but things tend to be simplified, especially when you're using just pure price action for this. So this gives you sort of an early signal on what is happening on the chart. So it's very helpful, and you're going to be at a bigger advantage if you're able to identify the trends just by looking at the charts. So let's get back to this. So in a more realistic scenario, your uptrend and downtrend will be more complicated than this. They look something like this. Yeah. So we have a series of smaller moves, and we'll talk about internal structure and external structure within the bigger impulse or correction move. So that is something that you need to be very wary of, and it's very important when you're trying to identify market structure. Think of it as waves and not necessarily as individual impulse and consolidation movements. In as much as it's think of it as waves and not as individual minor impulse and correction moves. Lastly, we're going to define a sideways trend. Now, this is market movement that is neither going up or down. So it's maintaining the previous highs or lows. So you can quickly define a sideways trend as a series of equal highs and equal lows, or a series of highs and lows that failed to break key highs and lows previously. So you can have prices moving in between the most recent high and the most recent low. So in this case, the market usually trends in a sideways manner, especially when there is a lot of uncertainty in the market. So you can have points in the chart where there is a lot of uncertainty, and that's when buyers tend to either accumulate trades over time or sellers tend to accumulate trades over time. And it's very helpful that we have these pauses in the market once in a while. So let's go back to our chart example over here and look at both phases in the market. So you can see that here we were forming, you can start that at the very top, like that. We had this move over there, an impulse, correction, impulse. Yeah, so at this point we have broken the previous structure. So this is my lower high. Yeah, we've broken that move, and then we had that impulse again. So I'll put it at this point because this is the base of the move that led to us breaking lower like that. So you can see that we went all the way up to this point. Yeah, we didn't have a significant move back on this impulse move until eventually at this point. Yeah, so at this point the concept of significant highs and significant lows is very important, which is what is the base of the move that finally broke market structure. Is it this point over here? Is it this point over here? Or this point over here? Yeah, so you can clearly see that this is the move that broke previous structure clearly. So this is what is going to be my next higher low or lower high for that matter. So the chart is going to look like that, and then we're going to move lower like that. Yeah, so it's important to know what is the base of the move that broke market structure, and that is what you'll be looking at, and prices shouldn't breach that point. Yeah, so we had that move like that, made it back up, and then we had a slight break of structure over here, and then had a period of consolidation, but all this time we didn't have a significant break until this point over here. So this is our significant turning point, and this is where the next lower high is going to be. So I'm going to mark this from here and then just move in lower like that. Yeah, at this point we had prices pulling back. Now this is very important. Again, if it's a significant high or low, then prices should not trade back above it. And in this case, what happened is we had this push up past. We had this push up past this point. Yeah. So in this case, I have ignored all these points over here. Why? Because they didn't lead to a break of structure. So this one didn't lead to a break of structure. This one didn't lead to a break of structure. The break of structure was towards the upside, and that was a significant change of character. So this now becomes my low. So in that case, you can mark that point over there and this point over here, as your reference for when the trend breaks again. Yeah, so in this case, buyers came into the market, pushed prices past this point over here to form a new high. And then now this becomes my significant low, my lower low. Yeah, so in this case, this is a key area, and you can see what happens every time prices came to this low, we held. Yeah, so this is where we had a lot of action, a lot of buyers coming in, and we held. So in this point, we tried to break lower, and we didn't manage to. And then finally, what happened is we had prices breaking this point over here. Yeah, so at this point, then I can say the trend has changed. Why? Because the trend is potentially changing. Why? Because we formed a new high. Yeah, now to confirm a trend change, which is something we'll also talk about, we need to have, number two, a higher low. So this higher low becomes valid once it became the base of a move that broke structure, like that. So in that case, we had that move over there, push over there, and then this move broke structure over there, like that. Now in this case, now we have 2 consecutive highs and 2 consecutive lows. This is a confirmed change in the direction of the market. Now we've ignored all these small moves because we're just looking at key levels. So when you're marking market structure, that is how you're supposed to approach it. Now let's go back to these notes and continue with the discussion. So now we've understood the concept of sideways trends, and we've understood the concept of significant lows and significant highs. So next we're going to talk about a change of character. So this is a very important concept, especially when we get into trading. And simply put, a change of character is simply when we have 2 consecutive highs or 2 consecutive lows being formed in the opposite direction of the trend. So in this case, for example, you had an impulse, correction, impulse, correction, impulse, and then we formed this push lower that formed the first low. Yeah, and then we formed a lower high. Yeah, so 1, 2, 1. So there is a high, a lower high, and then a lower low. So what is left is one final lower low. And in that case, after we broke this like this, then in this case, now we are in a downtrend, because now we have 2 consecutive lows following each other lower, and 2 consecutive highs following each other lower, and 2 consecutive lows. So in this case, now this becomes the start of a downtrend. If you look again, if it's an uptrend, we need to have that final push to form now a higher high. So this is 1, 2, and then once we come back to this point and formed the second instance over here, which is a higher low, and then we broke it like this, then now this part where we broke the previous high, that becomes the shift or the change of character that we're looking for, in which now the market changes from a downtrend to an uptrend. So it's very, very straightforward. So a trend change occurs when 2 highs or 2 lows are formed in the same direction. So that's one thing that we'll need to use when defining structure. Okay. The other concept that we need to be very familiar with is the concept of major and minor structure. So major and minor structure simply has everything to do with time frames. So when you're looking at markets, you have prices showing up at different time frames, and this will print out differently in different occasions, different charts, and the likes. So structure changes with different time frames, but at the end of the day, what you need to know is price is the same on all time frames, just with more or less details. Ideally, you can identify impulse and correction moves inside other impulse and correction moves, depending on whether you've gone to a higher time frame or a lower time frame. So major structure is market structure formed in line with the main trend, and minor structure is structure formed in line with the correction. Yeah. So there's the major structure and minor structure that looks something like this. So you can have your impulse move and your correction move and your impulse move like that, but then within this impulse and correction moves, there can be smaller moves if you go to a lower time frame that you can observe. So those are very important, especially when you're deciding on which time frames you need to be trading. So we've covered quite a number of things. Let's just go to the charts and check those two out. Remember, we are trying to identify, number one, clearly identify zones on the chart. And this is very important, again, when you're deciding how to go about trading. So remember, your market structure defines how you should approach the market in terms of whether you should be trading in an uptrend or a downtrend as a buyer or a seller. Yeah. So, for example, when you're talking about, so this obviously is a sideways consolidation. You just need to do the marking the way we've done it for you to sort of have a good understanding of where the structure is. So you can take, for example, this move over here. So we have this push lower. We have this push lower over here. And so far we have no point to mark as our lower high because we've not witnessed a break of structure lower. Yeah, we've not witnessed that move lower. However, in this push over here, this move over here, so let me just mark this. If you were to go to a lower time frame or something like 15 minutes, you can see that, just zoom out. You can see that in that larger move that we had marked, we still have smaller internal market structure. That is, you can see there is a low, a high, a low like that, and then a high like this, and then another low like this. Yeah, till eventually we had a change or a shift of market structure and the prices started going higher. Yeah, so in this case, you can see that there is a mini downtrend inside a larger impulse move, which might not be visible here. So it might not be very apparent on a very large time frame. It might appear even as one move like that, but inside we know that there is also a smaller downtrend inside. So that's the difference between major and minor structure, and we need to be vigilant when doing our analysis to know when we are dealing with market structure. Is it internal market structure or the major market structure? And in that case, what points to mark as lower lows and lower highs and the like. So it's going to save you a lot of time and effort. Yeah. Okay. So now, before we get on with something else, one last concept, before we get on to the strategy, one last concept that we need to be aware is the concept of premium and discount ranges. Yeah, concept of premium and discount ranges. So this is when you know what is the right time to enter and what is not the right time to enter. So price moves in waves, that one we've already discussed. It goes from cheap to expensive and vice versa. So when price is low, the market is at a discount, and when price is high, the market is at a premium. So when you are in an uptrend, obviously the market is going higher. You need to wait for prices to be at a discount for you to be able to enter. Otherwise, you'll be chasing prices, and that might be very risky as a trader. And this is where the fib tool that we had introduced comes in very handy. So you can use the fib tool to know what is relatively cheap and what is relatively expensive, and that is going to guide you on exactly when to execute your trades. So the goal is to always enter trades when cheap. Some pairs do not pull back very well, e.g. gold. So yes, this can be very reliable apart from when the pair experiences a lot of momentum, and this can be very tricky when you want to trade. So there are pairs that are very tricky when it comes to trading, especially things like gold, things like Nasdaq. Those tend to trend in one direction very aggressively, so they might not necessarily come back to a discount and things like that. So let's quickly go to the charts and come up with a concept or a strategy based on what we have discussed. Remember, we've said the goal is to follow prices in the direction of the larger trend, or is to trade in the direction of the larger trend. So let's quickly have a look at that. I'm going to use another chart. So step one is to go to a higher time frame. So what you need to do is to be able to identify whether you're in an uptrend or a downtrend very quickly. If you're not able to do so, then it becomes very difficult for you to trade. So make sure, number one, you're able to identify an uptrend or a downtrend. So in this case, we can see that from this swing, prices are tempted to push lower over here. So we are tempted to go lower. Yeah. So I'm just generalizing the price movement. Again, you just see this as price waves. So this is our most significant low. Yeah. But what happened? We had a move that broke this previous high like that. And then what happened after that? We had this move over here that broke this high. So this move is going to be where the low starts from. Yeah. So we have identified this as a potential uptrend. Why? Because you're forming higher highs and higher lows. Yeah. Now we need to be trading in the direction of the trend, but at a discount. That is, you need to wait for prices to pull back significantly, and that's where the fib tool comes in. So I'm going to plot the fib tool like that and plot the entirety of this impulse move from the bottom to the top like that. In this case, if you've not managed to edit your fib tool, just right click on it, go to properties, and make sure it is only reading, in this case, make sure it is only reading the 0, the 50, and the 100%. The other levels, you can reset them for other strategies, but in this case, these are the only readings that you need on your fib tool. Yeah. Okay. So once you have that covered, you know that it's easier for you to get optimal trade entries or better trade entries at a discount, and your discount is basically any price below 50. So if you get to below 50, this is where you'd be looking for buying opportunities. Yeah. So in this case, prices pushed to below 50 like that. So now you can get to your internal market structure to see if on the lower time frame, where are we changing the direction, or where is the trend changing. So I usually like using 4-hour time frame and 15-minute time frame for that sort of analysis. So on the 15 minutes time frame, we have something like this. We have this was an impulse move that broke structure. So we had that push lower over there. Just a minute, need to correct this. So we had that push lower like that, and then we had this move over here that now eventually broke this structure. Remember, the definition is very consistent like that. And then once we had that push lower, that's where the market is at the moment, and we basically failed to break structure. So we didn't break this push. So you can see this move over here really didn't break this high over here. So we do not yet have a change of structure. So what you're looking for in the lower time frame is simply a change of structure so that we can now continue trading in line with the higher time frame, which is an uptrend. So immediately I see something like this, then I can tell that now there are signs we might be changing the direction. And then now this becomes my significant low because it's the move that led to the break of structure, but we've not seen that as of yet. So after you have a confirmation, for example, in this case, a move higher like that, then now if at all the price comes back lower, then you can have trade entries. I usually try and get my entries after the first break and the pullback. Yeah, and this is below the 50 level. Yeah, so let's just recap that from the top. We've had prices being identified as being in an uptrend like that, and then we moved to the internal structure to wait for a change of character in line with this trend direction, which is an uptrend. So I hope that is very clear, very straightforward, and serves as a good guide on how to identify swing points, because that is what is usually very troublesome when it comes to market structure. How do you identify swing points in the market? So having said that, try and practice more on different examples. I think we can So we can try and look at another example. So something like US 500, it's usually very aggressive when it comes to trending higher. So it's something that traders ought to be very careful with, especially when trading. So let me just zoom this one in. So just from the glimpse of things, you can see that we are obviously in an uptrend, and the previous move that broke structure, the previous move, so we can start with here. This was a high that was formed. Yeah, so this was a high that was formed, and this point over here is where we had a break of structure. So if I just zoom this in, this is where we had a break of structure, and then we had this move over here. So this is the base. So actually this can also be a base because we broke this previous high like that, and then we came back into this move and then went higher. So we did something like this to that point, and then pulled back like that, and then now broke higher from there like that. So yeah, this is a bit aggressive. So the base of this move, I think in this case, let me just remove this. So here we had a consolidation, so it might not be very clear where the base is, but you can either pick this point or this point over here. So I'll just go with this point like that. Yeah. So we broke this previous high point over here like that, and now we went higher like that, pulled back, broke a high like that. Now in this case, what is happening? We are seeing that the market pulled back and broke the base of this move. What else has happened? We are seeing that we have failed to go higher. Yeah, so this clearly is a very significant high. This is a very clear turning point, and it's a strong high. So you're going to mark this because it resulted into a break of structure. So you can see prices are holding off at this point. Yeah. So anyone who was looking to trade from this significant high, remember we've said we are trying to trade away from the bases of moves that have broken market structure. So either if you're in an uptrend, then in this case, you might be a bit skeptical of this uptrend continuing in the direction like this. Yeah. So market structure is very important, and it gives you sort of that idea on whether to be very aggressive on a chart or not to be aggressive. So that's a very good example on an instance where we've not had a follow through in market structure breaking. And why? Because this is a significant point where prices broke both structure here, and we had this move over here. So this is one thing that market structure helps. So something like this, moving averages or indicators might not tell you that maybe the trend is about to change at the moment. But when you look at things like market structure, it usually makes it very, very straightforward and very clear. Okay, so let's just have a recap of what we have talked about and how to identify market structure. Remember, this is one topic that gives you a lot of advantage, especially if you understand it well as a trader. So we've talked about the essence of market structure, which is basically impulse and correction moves. And then we have learned how to identify these turning points on the chart. Remember, that's usually the biggest challenge, especially when identifying an uptrend and identifying a downtrend. Once you've gotten through that, we've also identified a consolidation, which is a sideways trend, and then quickly hopped onto our charts to see various examples. And then finally, we talked about the change of character. Now, the change of character is particularly the point where the market changes from an uptrend to a downtrend and vice versa. Yeah. And then we've talked about major and minor structure. And then finally, we've talked about premium and discount ranges, which is where should I be looking for trades in the direction of the market. So having said that, thank you for attending this session. It was a bit more technical, but at least it gives you the foundation, a very good foundation on how to identify market structure and how to shift from being a newbie trader to being a slightly more advanced trader when it comes to analysis. And remember to subscribe and share the video. In the next video, we will be looking at supply and demand, which is a very nice complement to this market structure session. Thank you.